Welcome everyone to the BlackPoint Capital Partners October 2025 market recap. My name is Daniel Mesa, managing partner here at BlackPoint, and I'm joined by our CIO, Arun Kaul, for today's call. Before we get started, just a quick note on this presentation. It is not a solicitation for any strategy or investment advice. It is purely for informational purposes. Please consult your financial, tax, or legal advisors for your individual circumstances. Now, with that out of the way, let's take a look at today's agenda. We'll cover a few things. We'll start off firstly with the economy, move on to rates, credit, equity, both public and private, real assets, primarily focus on the US dollar, and the S&P 500 risk premium. And we'll close out with some thoughts. Arun, let's dive in. Let's start with the global backdrop.
Great. Thank you, Daniel. So global growth forecasts overall are looking at growth around 3%. That's being led primarily by emerging markets, in particular Far East Asia. India actually has the largest projected growth, then followed by China. And the U.S. is at 2%, although the current GDP estimate for this quarter is potentially as high as 3%. And just importantly for investors, the main contribution from growth, if you look at the U.S. and China, given their size, they're approximately 45% of the overall contribution of global growth. India is a distant third. So really, when you're looking at global growth, we're looking primarily at China and the U.S. as the significant engines. Individual European countries, which are larger economies but are growing slower, and they contribute about 1 or 2% to overall growth. So very broadly diversified growth after you get past the U.S. and China contribution.
And with this growth concentration, Arun, in these regions, how might that shape investment opportunities going into 2026?
Yeah, so that's a good question because you have seen economic growth be higher in the emerging markets over the past several years. And of course, the companies, the global firms in the U.S. are still larger contributors to the overall market cap. So it's a little bit of a barbell approach where you can focus on specific regions and pick individual areas that are growing well, or you can look more from a stock picking perspective and pick some of those firms that are more global players. So I think it's a balance, even though the U.S. market is still more expensive. I think investors could potentially invest across both ways as they think about top down at the regional level and maybe bottom up from a stock perspective at the developed market level.
Okay, so with that, let's spend a little bit of time then specifically focusing here on the U.S. Give us your thoughts there.
So this graph shows the timeline of the current economic expansion, which is a line in red. It is we're just entering the sixth year. And what's important is that the economic cycles are much, much longer today, i.e. the last 2 or 3 cycles, which takes us back over the last 20 to 25 years. These cycles are now 8, 9, and 10 years in length. In the 70s and 60s, they used to be 3 and 4 years in length. So we have very long economic cycles. So arguably, if the Fed is able to reduce rates successfully now, which is what they're attempting to do, it would be a mid-cycle pause, and we would be mid-cycle on our way to another 8 or 9 or 10-year economic expansion. And certainly the administration is extremely active in terms of pursuing policies that are largely pro-growth, tariffs accepted. A majority of the other policies are quite focused on U.S. growth and are pro-growth in terms of reducing regulations.
And should we expect any turbulence on this average 8.5-year cycle length with tariffs, for example? Would we expect any big disturbances there?
Yeah, it's a good question. So you certainly are seeing localized disturbances, and you certainly are seeing higher levels of volatility for certain sectors, and you're seeing higher levels of uncertainty. But overall, you're still seeing fairly strong growth because it is being offset by pretty strong growth-oriented policies from the administration that are encouraging either drilling from a fossil fuel perspective or even seeking materials and minerals from a rare earths perspective, and certainly deregulating, and obviously it being a big push to drive foreign direct investment back into the U.S. So I think the bias is in favor of a longer term cycle, even though we're seeing a lot of policy volatility.
Okay, and another aspect that clearly will affect this cycle, the length of the cycle, is the Fed funds rate. So give us your thoughts on that front.
Yeah, so the big dislocation from the last few years has been inflation, which reached 9% in 2022, based on a very heavy fiscal stimulus from the federal government and a tremendous amount of money printing from the Federal Reserve. So inflation has now been reduced, but the Fed had raised rates up to 5%. So we had the highest real rates that we have had in close to 20 years. So right now, with inflation not quite at target, but back towards 2.5%, the Federal Reserve does have some room to reduce rates and still have real rates be around 75 basis points or 1%. So I think there is room for rate reduction, even though we're not quite convinced that we're going to get back to target, the federal funds target of 2% in the immediate near term.
And if we do see these rates stay above trend, right? If we don't go back to the Fed's target, what do you see in terms of implications for valuations across both equity and bond markets?
Yeah, it's a good question, because right now we're seeing inflation still somewhat sticky, if you will, but we're seeing some weakness in job growth. We're not seeing as yet tremendous stress in terms of job losses, although we have seen some higher profile layoff announcements. But we are seeing, we're seeing jobs slow down in terms of overall growth. So again, it's very sector specific or region specific in terms of how some of this is playing out. But I think overall there is room for rates to come back. And I think given the policies, it's still largely pro-growth or supportive of growth.
Okay, and on the inflationary side, now we're seeing it normalize a little bit more, but still remaining a little bit sticky. What are your thoughts on that?
Yeah, so inflation expectations are running right around 2.4%, or we're looking forward to about a 5-year period. So that's allowing the 10-year to stay around 4%. So that's about a real rate of 150 basis points, a little bit low by historical standards. The average might be around 200. So this is really the key, is that inflation expectations remain anchored. And the Federal Reserve does spend a lot of time focusing on this number and ensuring that the market believes that inflation expectations are anchored. So this, we expect, even the Fed expects to get back to target later 2028 period. So we're still looking at inflation above 2 for the next 2 to 3 years. But this is key in terms of remaining anchored around 2.4% or lower.
Okay. And do you see potentially a loosening anchor, if you will, if we do see a sharp decline in growth next year?
So that's a good question. There's, again, two pretty divided camps on potentially seeing inflation fall significantly. So right now, certainly energy prices that are lower are helping. Potentially, we've seen the worst in terms of increases in the cost of housing, both actual home buying and rents, which are large components inside the overall CPI calculations. So I think where we have it now, there's a reasonable balance of real rates get back towards normal, which is 75 to 100 basis points. I think that's manageable for the economy.
Okay, fantastic. So shifting then to credit markets, is there no landing? What should we be looking out for here?
So credit markets are trading very tight, which means that the spread over the risk-free government treasuries is very low. AAA bonds are about 100 basis points, and the lower rung of investment grade, which is BBB, is a little bit under 200 basis points. And those are pretty low by historical standards. We're looking at 25 to 30 years of data on this graph. So we are in an area that looks like a mid-cycle low towards historical lows for investment grade bonds. They're effectively trading as if we're having no landing, as the economy is going to continue to be strong. And importantly, companies have enough cash flow to cover the interest payments required for the outstanding debt. And it is true that interest coverage ratios are quite good for the larger investment grade bonds in the public market.
And are we as investors being properly compensated with these spreads and current spreads
So that's a
for
good
credit
question.
risk specifically? Yeah.
Yeah. So I think the credit risk, the credit risk is still low. The spreads are low. So the risk premium, the risk reward is low by historic standards. Assuming we have continued growth, then the answer is a cautious yes for investors. But if investors feel that we're going to have an economic slowdown or are more concerned about negative growth, then the risk reward trade-off probably skews a little bit towards the negative.
Great. So let's shift from credit over to equities. Give us your thoughts here.
So equity growth has been quite strong. Going into this quarter, the growth was expected to be 7%. We just completed, or we're just finishing the main bulk of earnings reports this week, and growth is now up to 10% for the quarter. So we are ahead of expectations. Our growth has actually beat and exceeded expectations this quarter. So earnings growth continues to be strong. For the year, we're looking at 10% growth for 2025 and up to potentially 14 for 2026. So 14 for 2026 might be a little bit high, but certainly our earnings have been very good, and they've been supported by rising margins for many of the larger tech and software and cloud names.
And if we look at this lower risk premium, right, for these great earnings reporting, what's going to drive returns into next year? Is it going to be earnings growth or multiple expansion, or maybe a combination of that?
The multiple is quite high. It really is coming back to earnings growth. So the market is relying on continuing growth and looking at double-digit growth. So if we're seeing 10% this year and 14% next year, then there's a significant emphasis or pressure on those numbers to come through, given what the valuations are. I think it's hard for the multiple to go higher, given it's at 23 times earnings, almost 23 times earnings today.
Yeah. So on top of earnings here in the U.S. and multiples, sorry, here in the U.S. being so high effectively, one of the big talks or topics of conversation this year has been international and the multiples outside of the U.S. So let's dive into that front.
Yeah. So the U.S., this chart is just showing the relative performance of the U.S. against international developed markets. And the U.S. has effectively dominated for almost 16 years now, where we've had consistent outperformance. Now, along the way, we have had pullbacks where the international markets have outperformed, but those have been no longer than a year. I mean, a year would be the longest period we've had. We have seen several quarters, but nothing persisting beyond a year. So this year, if this holds, will be the first time where international markets have outpaced for a full year or a 12-month or a 4-quarter period. So,
and if we go ahead.
Yeah, go ahead.
So if we focus on this performance, a lot of really interesting valuations outside of the US, should there be some sort of gradual shift, maybe like the barbell approach you mentioned earlier, to international?
Yeah, it's a good question. So if you look at the valuations, the US is certainly more expensive. If you look at growth, there has been a pretty large differential in the growth rates between the US market and international names. So it really comes down to the growth projections. So for 26 and 27, if we see international growth catch up to US growth, then I think you can make the argument for more of an international exposure. But if we see US growth stay ahead, numbers at 10 and 14% as the expectation are, then you can probably stay a little more focused on US stocks. But given the valuations, we do think it makes some sense to look a little more closely at international diversification, and you can certainly find areas that have better valuations with good margins that are very sector or region specific outside the US.
And making that decision on going to international will be very widely affected, obviously, by the weakening dollar. We've had a year of a significant decrease in the dollar's value. So let's focus some time on that.
Yeah, so this is a very long-term chart of the US dollar. And if you look at the high, which is 2022, that was a 20-year high. So the US dollar reached a 20-year high, was quite strong over that 21, 22 period. And from that, we've seen a correction. it's brought us back to where we were in the pre-COVID period, that 2013, 14, 15 period up to 2020. So we're effectively right on the 10-year average for the dollar. And you're right, this is a key indicator for leaving the U.S. If we're going to see continued weakness in the dollar, then I think it makes more sense to allocate internationally. If we're not, then I don't think it's as strong an argument. So definitely for those investors that are not dollar hedged, I think you do need to see weaker dollar to make the full case to move into international markets. And if you look back historically over the last 30 or 40 years, periods where international markets outperformed coincided with a weaker and a falling dollar by significant amounts, more so than we've seen so far.
And looking forward, but also looking historically, is that international exposure due to that weaker dollar, should that increased allocation go to equities or commodities or maybe a mix?
Generally, we would keep the mix the same, but there's definitely a link between a falling dollar and rising commodity prices. So in general, because the commodities are priced in U.S. dollars, as the U.S. dollar falls, you see those prices rising. So you certainly have seen an increased allocation to commodities in falling dollar environments.
Okay, so let's move on, and I think this will be our last slide for today. It's spending some time discussing risk premiums and whether or not we're, as investors, being rewarded favorably here.
Yeah, so this is the real challenge for investors today, is that equity markets in the U.S. are quite expensive. The Fed did reduce at the last meeting, so the Fed rate on cash is now 3.75 to 4, but the PE on stocks is over 23. So we take the inverse of that, which we call the earnings yield. So instead of price over earnings, we look at earnings over price. So 1 over 23, which is the PE, gets us to about 4.3, 4.4 on the earnings yield, which is very close to where the 10-year is today, which is about 4.1 to 4.2. There's effectively no excess premium in buying stocks today versus bonds. Historically, this range is about 200 to 300 basis points. So we might expect if the 10-year is 4 or around 4 to have an earnings yield of 6 in public markets, which would be a PE of around 16. And we are not anywhere near that today. So risk premiums are at 20-year lows for both compared to the bonds and to cash.
Okay, perfect, Arun. I think for today, that'll be a fantastic conversation and topic to end on. We covered quite a few broad topics during our conversation today. So if anyone does have any more specific questions, please feel free to reach out to your advisor here at BlackPoint or to our general info inbox, which is info@blackpointcp.com. Arun, as always, thank you very much for this presentation.
Great. Thank you.
Thank you.